Well, good afternoon and welcome here to London for an FS Club webinar on price versus value. Active management is still alive and well. And we have here as our guest John Keller, who's the CEO of Quero Capital. And John has an amazing view of life, basically between London and Zurich and many parts in between. And is actually an accomplished and wide-ranging thinker on a number of other issues, such as geopolitics. But that's the sort of attitude you'd expect from somebody who's into active management. He better be looking at what the world's up and about. Now, you'll know me, I'm Michael Mainelli. I'm the one of the directors is Yen, and I don't have a world view, but I do have a view on active management and passive management. And when passive management first arose, probably into prominence, arguably some 30 to 40 years ago, I was an amazing fan. There we were punching it to a big, fat, bloated industry that wasn't really doing its job. But as time has passed, it's clearer and clearer that this is a very nuanced version. In fact, many people, as you'll be aware, have often said that without the active managers, the markets would be even more dysfunctional than they are, were that possible. Anyway, that's what we're here to explore today. And our agenda, as ever, is only possible thanks to the tolerance of our sponsors who allow us to range widely and freely across technology, economics, and finance. And I think today we will touch on that. So don't be afraid to stick into the question and answer facility. Questions for Jean, which may be a little bit off target because he can handle them. He's got a heck of a brain. So what are we going to do? I'm going to get out of the way as quickly as possible. Secondly, we're going to have a chat with John. Would you do note 3 points? Firstly, the slides are already up, so you can browse them or go back on them if you need to. Secondly, it's being recorded and it will go up in approximately 2 working days, so possibly late tomorrow, so you can view it on the weekend with friends and family. But most importantly, type your questions into the GoToWebinar facility, because I'm here with you. I'm not on Signal or WhatsApp or reading my texts or my emails. But if you do send the questions in, I'll feed them into the conversation with Sean, and we should have really quite a dynamic and exciting time. And just before we have such a dynamic and exciting time, I thought we might have a dynamic and exciting poll. And Sean would like to know from you, what funds do you hold in your portfolio? Are they mostly active, an even mix of active and passive, mostly passive, or I don't use these things at all? Now, Jean, our audience is very swift off the mark, and we already have 50%, 58, 63% have voted, which gives you a flavor of the type of strong and quick opinions that people here have. We're well up to 80% of the audience, so we're just going to close that poll and present the results. And oh, interesting. Well, there's a lot we could do here to push things around. So we've got roughly 13% out, and then a third active, a third passive, and a third an even mix. So with that, if I may, Jean, the floor is yours.
Well, thank you very much, Michael. Thank you. This is very intimidating. I'm going to have to say something clever about active management. And that's okay. Is my presentation showing correctly? I'm assuming that it is. Yes. I'm gonna try to jump around between the various slides. Most of them were taken out of a presentation that we've made with some academic from the Swiss Finance Institute, and I feel strongly about active management for all the reasons that Michael has exposed, but also because I think the comparison, the academic work about active versus passive has actually been flawed. And by the way, I'll try to be as provocative as possible, so we can have a good discussion. But if you remember that the FCA inquiry into the value of the fund management industry, I forgot, it was 5 to 8 years ago. There was this massive research done as to on the closet indexing industry, and one of the things that is extremely frustrating for a boutique like ourselves is that we are being lumped together with all what the people call active manager, where quite an enormous portion of them are actually passive or closet indexer, as you say. And you can see from this chart, the yellow dots are passive managers. They have very low tracking error, and they're basically trying to copy an index. And the red, the dark red, are basically the supposedly active managers. OCF means the charges that the investors are paying, and you can very clearly see that probably a third of the universe is actually made up of people who are actually just index followers, and they sell this at very expensive fees to typically their retail network. So I just would like to leave that first thought with you, that whenever we look at the active management industry, we kind of don't look at the data close enough to actually make a fair comparison. Now, of course, one of the other aspects of the last 20 years in the fund management operation is size has become a factor in the ability to withstand the enormous fixed cost that is required. You know, our industry, the asset management industry, used to be a wonderful time when I started 35 years ago. You basically had a rotor screen, a brain, and basically someone would give you some money to manage, and if you were able to basically manage that money, you know, you were in business. Let me say that, you know, I've worked longer than BlackRock has existed. I started in '87, and BlackRock was created in 1988. And you know, it's telling that this industry was able to create a mammoth in such a short lifetime. Forgive me, I know I look very old, but it's not that long ago. And the same can be said with quite a lot of large, very, very large asset manager. And that was the wonderful thing. If you think about free market, if you're a liberal, if you believe in capitalism, which I do, with some caveats, which I'm happy to discuss, but what you should have is you should have incumbent firm, established players who are being challenged by the newcomers. The newcomers come, they do a better product, they do it at a cheaper price, which the passive industry has done. And then you have a renewal. That's a creative destruction that Schumpeter was very fond of. But the truth is, today there is a very, very clear correlation between size and profits, which shows that, you know, the larger you are, the more dominant a player you are, and the result is that returns are no longer the key factor of success. Now, I always say to my colleagues, and this is something I feel very passionately about, and that applies to a lot of current discussion in the asset management, including the ESG discussion, the only reason society should pay a fund manager is because we can produce excess returns on saving after fees. That's, you know, if we can't do that, I mean, no one would go to buy bread in a place where they deliver you the flour and the water. I mean, that just doesn't happen. But for somehow, people think that fund management is about many, many different things, but it's not about after fee returns. And that's the only social responsibility, the reason that, you know, the economy should be prepared to leave a drag to our industries, because we can maximize after fee returns on the saving pools. And today you can see with this chart that the key determinant is not performance for success, it's size, and it's very frustrating. So, you know, this chart is taken straight out of the FCA study on the industry study, and it shows that you know, of course, you know, people say, well, you know, the reason passive is so good is because it's very cheap, and the active managers do not beat the index, and you know, they're horrible, they're trying to basically take money away from the savings. But you can actually, this is a quintile division of the active management industry, and you could see that, you know, this is not the cheapest that adds the most value in terms of performance. This is out of the FCA. This is not a biased research, by the way. And of course, the more expensive, which I suspect is influenced by the rebates discussion at the time. You remember the study is done quite a long time ago, but the more expensive are not adding a lot of value. But there is actually no real correlation between price and value added. In fact, the fourth quintile, which is the second most expensive, does consistently outperform you know, and does add value. Now, you know, the problem is that over the past 30 years, we've had, and I've discussed it, a massive concentration in the asset management industry, and you know, the dominance of a large group is emphasized, is exaggerated by the ability to do cross-selling, and you know. It's a winner takes it all situation, you know, with the emergence of ever larger playing. I mean, you realize that BlackRock today manages more money than the French GDP, much, much more. I think it's close to 3 times the French GDP. It's absolutely extraordinary. Brand becomes very important. You know, this famous adage that you've never been sacked for choosing IBM. I have me as a boutique, you know, our firm, we've been told every week, we think your fund is great, but we prefer to do a BlackRock, Fidelity, whatever, put a name, Amundi, whatever, good firms, but not necessarily the right criteria. They have huge economies of scale, because our funds, we run about 3 billion, we have OCFs, non-asset management charges that are higher by the share, the ability to finance new funds, and there are all sorts of market distortion to free competition, which I will talk about. The problem is that the academic research does not show size to be a factor in deciding who, in trying to predict who's going to outperform, and it's actually not. In fact, the research is very consistent. There are few factors that predict performance, and boutique tends to be better. There's a research done by the Cass Business School about 5 years ago that shows very clear evidence that smaller boutiques are better at outperformance than larger groups, and I think that's a fact. The other thing which is quite surprising is there is an enormous sort of a bias towards the recent performance, despite the fact that a lot of people in finance know that, we've been writing on all our presentation, past performance is no indication of future performance. It's almost the only disclaimer that you see on any presentation. The fact is it does. And, despite the fact that past performance is no predictive value on future performance. So, I just, the problem is all those things hamper free competition and make this almost like a socialist, a Soviet type of industry where you have very large players, you have asymmetric information between fund buyers. I'll talk about some of those structure. I want to show you this chart, and I just need to explain it a little bit. This is a research that we've done and was published in 2020 in the Journal of Portfolio Management, and it shows that FIDE manager, it's in the U.S. institutional market, I believe, and it's the returns of the investment manager studying more than 8,000 hiring decisions over 10 years, and it shows that the people who on the right hand side you have on the you have the Hyde manager who's shown extremely good performance on the left-hand side. So they made the beauty contest. As we say in French, the bride looked pretty. And if you look 3 years out, they have actually significantly underperformed the people that you find. So it shows clearly that in one of the most professional side of the markets, that the people who were supposed to add value selecting a new manager, they were overwhelmingly influenced by recent performance, and that was the wrong thing to do. And I think this chart is very telling. The truth is, there is some research that is being done over key factors that will determine future performance. I've already talked about the fact that boutiques tend to be to outperform large players. I've talked about the Andrew Clare research. The soundness of investment thesis is something that comes back rather than trying to be all things to all people. Performance-linked bonus, employee ownership, firms that are 100% employee-owned do tend to do better. Board of director, a very high active shares is something that is very, very important. It's quite telling. You remember the first chart I've showed about Closet Indexter. The lack of affiliation with some retail network and large, funny enough, I love this one. The number of PhD in a firm. I have to have a disclaimer. I have no PhD, which puts great shame to my parents. But the number, a strong positive culture, the large opportunity, and obviously fees is important. We're talking about trying to maximize, but performance is neither linked to size nor to brand, and yet it's the most determinant factor in today's industry. It's very hard to know whether fund selectors do a good job, and there is no, it's probably one of the most extraordinary things given the amount of research that finance is subject to. No one is actually looking at fund selection and the outcome. So I've used the HFRI fund-weighted composite and the fund of hedge fund, which to me is a good indication of whether there is some value added in fund selection, whether those people who tell us that they can select fund and put them in people's portfolio, managing saving, are actually adding values. And of course, this is a very coarse measure of the point I'm trying to make. But you can clearly see that the fund of hedge fund, the people who were selling their proposition, as you know, we know how to build blend funds together, have done an atrocious job, and the difference is way beyond just the additional layer of fees. By the way, it's massive, and that should worry us as an industry. And as I said already, no one is looking. But I draw you back to the consultant market investigation of 2019 in the UK, where the quote was, on a net of asset management fee basis, we have found little evidence that buy-rated product by the consultant significantly outperformed their respective benchmark. And that's quite an extraordinary statement. And the people who remember this study remember that the industry had a sissy fit, and they basically tried to have this phrase watered down, and the FT covered it, and it all went pear-shaped, and no one is talking about it anymore. But fund buyers remain quite secretive about their selection process and their results, and it is extremely frustrating. And I think it's against the greater good, in as much as, again, I believe in destructive creation, I believe in the idea that in a free market, the new players should be better and be able to displace the established players, and in fact, the anecdotal evidence is that the fund buyers make some requirement, and I'm being subjected to this every day as a boutique. They want brand. They tell you that they want minimum side, despite the academic research, despite the fact that we've been put under an enormous amount of regulation to adjust for the effect of size on liquidity and the 2008 disaster that we had. They want minimum track record. I think that's fair. I'm happy with that. And they want maximum fees. I have been told numerous times that my product was better but more expensive than a lesser product, and as a result, the fund selector was not prepared to buy it. It's cretinous. I mean, it's absolutely, if you're a banker, if the person who looks after your assets makes, the only criteria should be risk-adjusted after fee returns. That's why society is paying us. And it's quite shameful that some people say, oh, well, we're just going to, it's actually quite interesting. There is a former fund selector from a UK group who's now is a non-executive director, an independent director. And she says she was under pressure, and I'm very happy bilaterally to actually push you to her LinkedIn page to select cheaper funds just because they were cheap. That's retarded. Some of the criteria don't even fit the client's need. The availability on a platform. That's a huge subject I'll come back into. Wide tax reporting. If you want to be on a large Swiss retail bank platform, you have to do tax reporting, which is massively expensive, to all sorts of jurisdiction, across the EU and the world. When I feed some of the platforms data sheet that they require from us for each fund class, there are more than 1,000 data points. Payment of rebate is another problem, and MiFID has not got rid of that. And none of those criteria serve the client's interest. And those structural issues do hamper free competition, and it's a shame that we're not talking more significantly about it. So, I think there are a number of obstacles that are in the way of free competition and competitive market, and I'd like to suggest what I think, which is a highly biased subjective views, but maybe it will lead to a provocative discussion. There is a confirmation bias, past performance. I think I've made the point with those few charts, and I talked already about the power of the brand. One of the things which is very important, and very few people say, when you're a larger firm, you can hire product specialists that speak very well. And, the typical, forgive me, but, if you have a fund manager that is not really good at presenting, who's not being able to make his case cogently and powerful, you're at a disadvantage, which is weird, given that when you go and see those large firms, they hire product specialists, i.e. people who are neither salespeople nor fund managers, but who are paid to make a case. And that has a halo effect on the product. there is a risk asymmetry. It's probably one of the most untalked about agency conflict in the industry, which is, when you're the head of a large private bank and you talk to your fund selector, you will say to him, I don't really care what you do. I absolutely don't care about what you do. Just don't get any Madoff. That's all I want. And, there's a loss aversion at the level of the fund selector and from the management and the board. And again, that doesn't serve the clients. And I think that's really a shame. There are no objective measure of fund selection. I mean, you don't see that. You remember we had that problem in the wealth management business in the UK in 90s, and we had the ARC measurement. And I think to a large extent, there's been more transparency. We haven't seen that in fund selection. There is not, a place people will say, come to us, we're fantastic, we're able to select great funds, but you don't see the results, and that's a shame. There are structural issues, and that's probably one of my biggest bee in my bonnet. It's probably one of the platforms have an overbearing impact on fund distribution. And it's a private market with club-like characteristics, and it's extremely expensive. Now, I'm talking to a UK audience. Take Hargrave Lansdowne, which is a dominant player. They won't take your fund. They will not take your fund. I can immolate myself in front of the building. They say, no, you're too small, it's too much work, too much costs. And the problem is today they perform a utility function to the fund market. And as a result, they create biases in free competition that give far too high barrier of entry, and they're sort of binomial. You're either in or you're out. And if you're out, you simply not going to be. And when you're a small firm, it creates structural barriers that are very complicated. Regulation has favored small player. I think the dream of the legislator and most regulator is to have 5 firms and to basically have a sort of intimate relationship with them. And all those small player, all this Keller guy at Quero Capital, we don't really care. He's far too noisy, and on top of that, he's got a funny accent, and they won't get rid of us. SFDR, the latest European Union directive on ESG, is another one. I mean, the taxonomy is 610 pages. BlackRock has probably got 100 lawyers able to analyze it. I had to read it. I haven't, by the way, but if I wanted to understand what's in it, I'd have to read it. And all that, MiFID, UCITS 5, UCITS 6, all those enormous regulatory. When I started in the industry, the Luxembourg, our funds are based in Luxembourg. The Luxembourg fund regulation held in 300 pages. I've stopped counting when they passed 10,000, and they're way beyond 10,000 now. And I think that's quite extraordinary. And that there is still no markets, a national, common market in financial products. Now, you in the UK, you think, oh, Jesus Christ, thank God we're out of there. It was bureaucratic hell. I'm not quite sure it's better in the UK. There is still an enormous dominance of national brand, which have nothing to do with performance, and national champion are still dominant. If you look in France or in Switzerland or in any country at the moment, there is an enormous dominance of the local names of the home team, which there is I've talked already about the fact the utility function of the platform, and I just want to talk about that in the context of the 2 scandals we've had in the UK, H2O and Woodford. Those were market darlings. There were people that had great historical performance. I know them both. They're great people. They're great fund managers. They really are. But the platform pushed them to the hilt. They really did, and they said to everyone else, "Oh, Jesus Christ, you're too small. We're not interested." And you've seen the disaster that it's created for the retail investments. The last problem is that the agency conflict is that there's still too much competition from the in-house product. If you go to a large wealth management bank, I mean, the Swiss are probably the most guilty of that. There is still enormous dominance from the in-house product. I'm a client of one of the large Swiss banks, and whenever I say I want to invest in Asia, they bring me their product, which invariably is one of those closet index and adds very little value. I think you know what my remedies are. I think we need to have a regulatory level playing field. I've talked about this. I don't want to repeat. I've promised Michael that I will limit my comments to 20 minutes, and I'm coming to, I've exceeded by 45 seconds. As I say again, profit maximization on saving is the only reason this industry exists, and we should start to focus on it socially. I'm done with my formal remark.
Wow, that's fantastic, Jean, and nobody's going to accuse you of not putting wearing your heart on your sleeve there. And I can feel the passion for reform. I often feel the same way. Well, let's get cracking. Now, you proposed really three broad areas that needed to be tackled if we're, as potential remedies. We need to remove the behavioral obstacles, the structural obstacles, and the agency conflict obstacles. I'd like to pick up the second one, the structural first, because this thesis that you advance, which is, I think, very robust, that the regulators and the industry are raising the barriers to entry, squeezing out the small players, increasing concentration, and therefore removing competition and innovation for that matter. So if we pick that up, I've got a few comments here. Particularly interesting one here from Derek Scott. He says you didn't mention so far increasing ESG requirements being imposed on fiduciaries. Where do smaller managers score on TCFD and other reporting?
Well, this is actually it's part of it's part of the same. By the way, I can't stop sharing, but I think I'm not going to go back to my slides. So I'm very happy if we have faces instead of the address of Quero Capital. One of the things that has happened in the ESG, and we're looking at it in the headlines, is the large group have just basically plugged an ESG name on an existing product. I don't want to accuse, DWS or anyone else, but the reality is there's been quite a lot of greenwashing. And the regulation was supposed to end this, and we're at the very, very beginning of the process. But yes, ESG is very problematic for a small group. The only thing I would say is, we manage very specialist products, and we are able to give far more meat on what we're doing because, for example, we have a microcap product, and we do engagement with microcap, which I think we're the only one to do. So I think that, it remains true that ESG is an extra layer, but I think small groups can probably more easily differentiate themselves with that because they don't have such legacy business as the large one like DWS or Goldman or whoever. Have I answered your question?
Yes, I think so. We're going to come on in a minute. Martin White sent a link to a paper he wrote, and I'll stick that in there. And he was wondering if you've done it, but let me get that in, and we'll take some other questions quickly. I mean, one of the things here is if you cannot predict who can outperform, says Martin, surely minimizing the expenses is the logical thing to do. And he would avoid national brands. He's going to put his family into Vanguard's cheapest. Any thoughts on that?
Yeah, I think you can. I think you can predict. I think there are research that shows some predictors, some factors. As I said, employee ownership, the incentive structure, the investment thesis, I think there are some. And yes, if you were not able to predict it, the cheapest, but I think it's simply not true. And I think all this research that is being done on active versus passive lumps together the active with some player who should probably have disappeared and maintain themselves in the industry because they have a large retail distribution or there was a positional, they have a advantage, which is not linked to performance. So I do think you are able to select. Yes, it's hard. I mean, predicting the future is hard, yeah. And ultimately, but that's what we do in finance.
Well, Martin is curious, and it's in this paper from UKSA on long-term incentives, but is part of the problem the fact that we charge percentages? Should we not be charging a percentage of everything? Fixed fee has always been talked about. What do you think about that?
This debate has gone on as long as I've been working. 35 years I've heard about this sort of ad valorem fees versus fixed fees. the problem is that to actually, forgive me, I'm going to probably invalidate some of the things I've said in the past, but active management is expensive. And if you look at the profit margins of Vanguard versus mine, I'd prefer to be Vanguard. So, active management is expensive, and, there is some link between cost and asset size. If you look at the quoted asset management firm, I think I'm fair to say that on average, their profit margin is about between 15 and 20% historically. It doesn't make it one of the most profitable. Of course, it makes it much more profitable than retailing on Tesco and Sainsbury. But I don't think that. The question is, you get what you pay for. My former boss used to say, if you have a brain tumor, would you ask the price of the oncologist, or would you just not want the best one? And I think economically, we should really go for the best one. If you don't care about what you eat, you'll be very happy in the McDonald's. But if you want to take your fiance or your partner out for a lovely dinner, you're probably going to look at the star, the Michelin star.
So somewhat unremarked, and possibly slightly more in America than here. But a lot of people have pointed out that Vanguard's business model depends heavily on stock lending, which is interesting when you think about it. I've actually purchased the stock, and now my tracker fund is going around and shorting it. Any thoughts, or helping to short it? Any thoughts on that?
I think that there are a lot of issues, including this one, on the passive industry. That is obviously, there is some hidden cost effectively, because if they're making money lending your stocks, surely you should have a discount, and they give you some, but they don't give you all, and that's quite, but there are so many conflicts in the passive industry, probably just as many as in the active ones. But I think people don't see that. One of the things that I always get very I get a lot of pushback is we cannot all be passive. If we are all passive, there's no market. You need the active. So everyone says, oh, well, you need the active. Yes, but I'll buy passive. But ultimately, if we all buy passive, there is no market. You need the mechanism of price discovery to work in a free market. There is a study that was done by Bank Pictet, who is one of the large European asset manager, that showed that industry sectors where the proportion of passive owner was larger were more inefficient in terms of return on equity than the sector where the passive industry was not as powerful. And I think that's really something we should worry about, from as finance actors. The last thing I will say, which I think is to me is a killer, is the way passive claims they can do ESG is an absolute joke. It's a farce. It's an absolute farce, and I do not believe they're sincere, and if they are, they're delusional.
Now, Graham Elliott makes a point that he thinks one part of the solution is success geared fees. You're only paid extra to the extent you outperform the market. Martin White seems to agree with that. Best outperformance after fees. And there are a couple of other comments along the same line. So the audience seems to be sort of agreeing that is one area. But let's tackle another.
Can I just say something on this? Because I absolutely agree. I love performance fees, and yes, I'm very happy to have very little sort of passive like management fees. You cannot sell a fund today with performance fee in the long only business. If you can, please call me. I have a job for you, but you cannot. So yes. But this focus on total costs is just simply not working, and as a result, I cannot, in some countries I'm banned to do this, and in general, like in the UK, there is not a single fund buyer who will buy a performance fee on a fund. Just that's it. End of story.
Okay. Well, one of the things that Derek Scott would like to look at is another performance measurement bugbear is the general use of time-weighted rates of returns rather than money-weighted. I must say we here did quite a bit of work with the London Mathematical Institute, where they were looking at the fact that so much of the presentation of data is using ensemble averaging rather than time averaging, where you can actually see what's happening. Any thoughts on that?
I used to be in one of my previous work, I used to be the person who made our track record AIMR compliant. And as you may recall, times weighted was the key to become AIMR compliant. You had to basically show those composites and all this. The truth is, it's not taken on as a you know, if you say to your clients in the industry, if you go to a pension fund and you tell them we are GIPS compliant, which basically is time weighted, no one cares. They look at you with a blank look, and in fact, I will submit to you that, you know, quite a lot of very large players are simply not claiming GIPS compliance because no one cares. I think it's a shame, but I think it's a fact. I think I'm correct in saying this with some nuance. You know, I'm a specialist fund manager, so you know, all our series are time weighted. I think it's the proper way of looking at the performance of a fund manager, you know, I think the people who do it differently are just simply misleading, depending on the cash flows that have happened.
Okay, I'd like to move on to some of the other issues here. So, core to your thesis, Jean, is clearly that there are some people who can consistently outperform. Con Keating sort of doubts that. Isn't the problem with active the lack of time consistency, or you know, few funds are consistently good? But we've also had people out there, Philip Tetlock, Dan Gardner, on super forecasters. Martin White points to examples of Terry Smith over here, or Warren Buffett in the States. Do these individuals exist?
I think they do. I think they do. I mean, I wouldn't do my job if I didn't think they existed. I do have to say that I think they're very rare. Let me take the first part of your question first. I think the time period under which you look at a fund manager, it can be misleading. And I think, you know, only the academic research that will look at sort of, you know, non-overlapping decades or lusters or whatever, you know, is going to answer that question. For example, you know, our firms on European small and micro cap, we are value manager, and value has underperformed over the last 5 years, and they underperformed because anything that has any growth was supported by the very lax monetary policy, and there were very, very small number of technology and biotech stock that did extremely well, that carried all boats with them. And if you're a value manager, you're pretty lonely. Does that mean we have no skills at Quaero Capital? No, I don't believe it does. I think, you know, we had distortion in the markets, and you know, and if you held our funds through this time, you've done much better than the index. In fact, you know, you've even beaten the S&P 500 over the duration of our funds, despite it's a completely different universe. But as you know, it's been a very, very difficult index to beat. So I think there is some unfairness in the use of the time frame to discuss. Now, you know, it's funny, people always mention Warren Buffett, but, you know, if you held Berkshire Hathaway, there's been some horrible periods. You know, another legendary investor that people talk very often about is John Maynard Keynes, who's, I admire him greatly. And as you know, he went bankrupt twice or 3 times, I forgot, and was bailed out. So, you know, I think this notion that there is a guy who has this, you know, golden finger, and that, you know, whatever he will touch or she will touch will materialize in long-term money. I mean, in the UK, take the example of everyone thought Crispin Odey was finished because of his bad 2 years. Well, he's made up for it now, you know, and so I'm not saying, you know, I'm not making any value judgment on Berkshire, on Crispin, or whoever. What I'm saying, it's all those research are very time dependent, and I think in a lot of the time when it comes to the press, people are unfair with the time series they're using.
Okay, Hugh Purser has sort of a two-part question here. Firstly, you know, he studied modern portfolio theory, as many of us did. Is it relevant? Can it be usefully applied to manager diversification and selection? And the second question, that, you know, many people keep predicting that AI and other new technologies will eventually replace human fund managers. What's your view?
Okay, I love the question on modern portfolio theory, and I will warn you, will have to interrupt me because I can talk about it for hours. Modern portfolio theory is a fantastic breakthrough, and I have on my desk the initial paper of Markowitz and Bill Sharp on capital asset pricing. I love it. And effectively, you remember after Irving Fisher made this thing about RIR, the CFO of a firm didn't know how to define the return on equity. He knew pretty much what was the return on debt, but he was in a complete black room with regards to what are my investors requiring when I want to discount cash flow in terms of return on equity. And Harry Markowitz came and said, well, if you make the hypothesis that the market is efficient and that there is some information in the share price, basically this is the tool that you need to use. And Bill Sharp came, you have capital asset pricing model, and the CFO was sorted out. It was all wonderful, and now we're being taught, the Brealey Meyer book about, CAPM and the required rate of return on equity, the weighted average cost of capital, and we can do our IRR, and the corporate finance guy, the CFO is happy. But we took all those hypotheses which solved a real hand-on problem with assumption that were very reasonable if you're a CFO, which is, well, let's assume I have no view of whether the market is right or wrong. I have to assume it's efficient, and I will take it as a source of information. And we turned it on its head, and we said, this is the way we should manage money. And yes, strong form market efficient, and we completely perverted the intellectual framework in which those two seminal papers were written in. And I think it's absolutely catastrophic, because of course we know markets are not always efficient. We have enough evidence. The famous black swan, Mr. Taleb made a fortune selling that book, and I think he was right. And there are also many conceptual problems intellectually, academically, with using those two papers as the basis for portfolio management. One of them is that the utility function of risks of investor are not continuous, and they are not infinite, unlike what the theory does, which means, there is a stage at which your private clients will tell you, well, I'm sorry, I just don't want to take that risk. It's a little bit like you're in an airplane at the end of the runway at Heathrow, and there's a mechanic that comes and say, well, sorry, we need a seat, it's empty here, we're going to put it in another plane. And then, another one comes, say, well, we also need the coffee maker because, you're not going to drink coffee. At what stage are you going to say, I don't want to go into this airplane? Well, I just don't, I want out. And it's the same, in financial market, the clients say, I want out. I will say something provocative, but true. None of the subprime failed on what they had promised. Yeah. The world collapsed in 2008 because subprime was, we had made sausage was toxic. We didn't know which sausage was poison. In fact, the experience of default, I think I'm correct in saying, stayed around 21, 22%, and the equity tranches on average were 25%. So all this fuss.
That's you were right about I love the MPT, but we're coming close to the end of time, and I'm going to try
so
and
sorry,
wrap
I
up.
talk too much.
No, you don't. It's absolutely superb. I'm loving it. I mean, what we're seeing here, I've got a whole host of comments from Martin White, a whole host of them. He's wondering if you'd sell direct to retail customers. Look at the paper you wrote. You'd like to write articles. I'll send you all of his comments and let you two take that offline, Martin. There's a lot there, and I think you two really should have a chat. But what you've started off with, I think, John, was you spoke about information asymmetries, agency problems, frankly, externalities, and a whole bunch of barriers to entry leading to a lack of competition, all of which, I think we can see in spades. But there are other industries like this too. So education is a good one. I have no idea what's going on there. The pig in a poke industries. And then we see, particularly in areas like the big four or the actuaries, when you have to do something and you really don't know what their performance is like, you go to brand, and that increases size. Make it a little difficult to discern, is it the brand that's the size, or is it the size that creates the brand? And I think in this particular space, there are also some minor things going on here. For example, across most of the West, you're constrained in handling your own savings. It's got to be done through funds, even if you want to. So the structure actually gives them a huge inbuilt advantage. So I believe that your structural point's very well made. I think on the agency conflict, your point is very well made, and there are things to be done there. I think what this audience is interested in is how we measure and what's out of performance. And so Martin says here, if we can't identify individuals with good long-term track records, even if we've tried, and we can't understand how they've outperformed, then it seems to me it's not worth looking for active managers at all. So a closing question for you, I think, from this audience, and there's far too many here. How would you go about choosing a manager? What would you do in sort of 60 seconds?
Yeah, the research shows that employee-owned firms tend to outperform and boutique tend to outperform. So, I would go to boutique specialists with very high active shares and look for them to be employee-owned and the incentive to be right. And I think that this is probably one of the most clear result of the research. So I do disagree that you cannot predict who's going to outperform. I think there are some factors that help you in this prediction, and you will not have it right all the time, but you can actually be well ahead of the curve in using those factors. I will then look for a very clear investment philosophy and investment thesis, and that's for you to decide, because I can't make the choice in where you want to invest. But I think it is actually a misnomer to say that there is no clear predictor of future performance for active management, and that's a shame. And this has stuck in people's mind, and it's objectively wrong.
Yeah, and I think there's another interesting point here Martin also makes, but he says, if you have 10 funds and 3 of them have good weighted returns, close the other 7 and you look great because nobody's tracking it. But if you're a small family-owned firm and a boutique, you don't have 10 funds that you can start hiding like that. So you're even more transparent in that regard. Well, folks, I mean, is that not clear? That's just fantastic and straight advice. Stop playing with the big boys if you really want to get good returns. Go focus on the boutiques. Look at the ownership structure, and look for a decent program and plan of action, and then work with them, which I think is really good advice if you really care about your money. So here we go. Just a quick round of thanks. Firstly, to our sponsors. I know that many of you are involved in this field, so I needn't tell you that what John's talking about is very important, and more competition in our industry is fundamentally one of the root causes of many of our problems. We could talk about banking and other things as well, but let's move on. Secondly, the audience. Whoa, today was overwhelming. You really reacted, in particular to Jean's comments and questions, so you were provocative. As ever, go and look at the website if you want to see things that are coming forward, but we're going to have another provocative session on Monday on corruption, capital, and power, today's world through the lens of corruption. So if Jean didn't excite you, which I'd be surprised, you'll be pretty irate and upset by Monday afternoon. And very, very finally, Jean, may I thank you. It's great to see somebody just get out there, pitch, and the emotion, and we need emotion in this sector, is really important. And I hope that today in some way leads more people to think about spreading it out and giving the smaller boutiques the chance that they deserve to prove themselves, because the big boys aren't quite doing it really. They're just following the herd. So I really appreciate it, and thank you.
Thank you very much. Thank you for having me. It's a real honor. Thank you so much, Michael. And thank you everyone for listening.